Wow, we were just talking in the break. It is a tough market out there. How are you taking shelter or looking for opportunities?
Well, we're taking shelter by having an increased cash position. And for the very first time in a long time, actually cash pays us something. So we're actually, money markets are paying, close to 2.5%. And then the 2-year bond is paying over 4%. So we've had a lot of money in cash over this last few months, and now we're actually getting to deploy them when they're earning something, because we're in a waiting game. We need to see some direction that inflation is actually starting to go down. We got whipsawed in August when inflation went up instead of down. And so everyone is nervous. Market does not like to be surprised, and they got surprised in the September 13 numbers.
And yet you say that there's still pockets of this market that are still being too dovish in terms of pricing in and earlier than you think will happen easing from the Fed.
Yeah, I think that the market is pricing in certainly some Fed increases, but we're a bit worried that they may not be pricing in everything because they really want to see inflation numbers go down 2 months in a row. But there is pocket of opportunities, just like in any markets. And it's important to actually dollar cost average in some of these companies that could benefit from higher interest rates, because we know they're here and they're here to stay for a while.
How much does fixed income play into your portfolio? Because we continue to see these treasury yields higher, the 2-year yield continuing to rise for a 13th consecutive session today.
Yes, that is so true. And but we do think it's a lot closer to the eventual terminal rate. And if you buy a treasury and you have a 2-year horizon, you hold it for 2 years, you're going to get your principal back. So it's a way to get a little higher interest rate while we wait, knowing that it may be volatile if you need it before 2 years. But if you hold it to maturity, you're going to get your money back, and you're going to get a little bit over 4%, which is really quite a good return right now.
Yeah, given, of course, where yields are going, given the backdrop of inflation, what sector-specific calls are you making to hedge for rising prices as well?
We really like the payment sector because, credit cards, since we have inflation, when people charge more, cost more for their goods and services, and so they get to make more money because of inflation. Also, they don't have a lot of employees. It's a bit more of a service, so the cost of inflation for the employees is rather controlled as opposed to other companies. And so the higher inflation, the higher prices, the more money they make. So we think this is a benefits from higher interest rate. Plus, they're making a bit more interest on the spread on their net interest income as well. So we really like that payment area. And we also like defense. We think there's going to be a lot more money spent on defense with the war in Ukraine.